Welcome to Section 7, the final content section of the Payroll and Workforce Cycle training. This section is where everything comes together. We have spent 6 sections building 2 separate tracks, the employee payroll process and the contractor process. Now we step back and ask the harder question: how do you apply both tracks in the real world, where clients have mixed workforces, edge cases, and compliance gaps that span both? That is what advisory application means, and it is the highest value work you will do. By the end of this section, you will be able to compare the employee and contractor tracks side by side across every key compliance dimension. You will identify the advisory priorities for 5 different workforce profiles. You will analyze real case scenarios and know exactly what to do. You will recognize the 14 red flags that cut across both tracks, and you will apply the process improvement recommendations that give clients the strongest protection going forward. These are the skills that define strong advisory work. Before applying advisory judgment, you need to see both tracks clearly in a single view. Employees are paid through payroll gross to net, taxes withheld. Contractors are paid through accounts payable, full invoice amount, no withholding. Employees receive a W-2 by January 31. Contractors who were paid $600 or more receive a 1099 NEC by the same deadline. Employees complete a W-4 and I-9 before their first paycheck. Contractors provide a W-9. Employees are governed by an offer letter and company policies. Contractors are governed by a services agreement and a statement of work. The primary compliance risk for employees is missed tax deposits and wage and hour violations. The primary risk for contractors is misclassification. The worker is actually an employee. 3 more dimensions matter enormously. Benefits eligibility applies to employees per company policy. Contractors receive no benefits. FLSA overtime protections apply to non-exempt employees. They do not apply to contractors. Workers' compensation and unemployment insurance are required for employees, not for contractors. And when a relationship ends, employees go through a formal separation process, final pay rules, COBRA notices, and exit paperwork. Contractors simply receive their final invoice payment. There is no separation process, no COBRA, no final pay timing obligation. Every one of these differences is a point where misclassification creates retroactive exposure. Different clients need different advisory focus. For a company with all employees and no contractors, misclassification is not the issue, but full payroll compliance still applies. Make sure every employee is correctly classified as exempt or non-exempt under FLSA. Confirm state-specific requirements for final pay and sick leave. And start ACA tracking if the company is approaching 50 full-time equivalent employees. For clients with heavy contractor use, common in tech, consulting, and media, the misclassification risk is at its highest. Contractors often perform the same work as employees. Engagements run indefinitely, and some contractors work exclusively for the company. Run an annual classification review. Apply the ABC test for California, New Jersey, and Massachusetts workers, and make sure every statement of work is deliverable-based rather than hours-based. 3 more profiles require distinct advisory approaches. Staffing agency workers are the agency's employees, not the client's, but co-employment risk exists if the client exercises too much control. Review the staffing contract for joint employer language and confirm the agency is handling all withholding and workers' comp. For gig or platform workers used directly rather than through a platform, the standard classification tests still apply independently, including state-specific carve-outs. For multi-state workforces, which remote work has made far more common, every state where an employee works creates payroll tax obligations, and every state where a contractor works may apply a different classification test. Conduct an annual state nexus audit covering both tracks, and register before the first payroll run or contractor payment in any new state. Case A is one of the most common and most costly misclassification patterns. A contractor has worked exclusively for the company for 3 years with no defined end date. This fails the IRS relationship type factor, indefinite engagement with a single client signals employment. It also very likely fails the state ABC test, since the work is not clearly outside the company's usual business. The advisory response is immediate. Rerun the Part 0 classification test today. If the worker should be an employee, convert them prospectively. Do not wait for contract renewal. Then assess the back taxes owed for the misclassified period. Back FICA for both employer and employee shares. Back FUTA and SWAY, penalties and interest, plus possible back benefits exposure. Consider the IRS Voluntary Classification Settlement Program to self-correct with reduced penalties. Going forward, set a maximum engagement duration policy of 12 to 18 months that triggers a mandatory classification reassessment. Case C involves a contractor paid $4,000 through petty cash reimbursements rather than through the AP vendor record. Because the payments never entered the 1099 flagged vendor master, they were never captured in the year-end 1099 total. The company underreported this contractor's 1099 NEC. The fix: issue a corrected 1099 NEC immediately, then implement an annual reconciliation of petty cash and reimbursement records against the vendor master to catch payments made outside the normal AP channel. Case D is a payroll variance alert. The total is 18% higher than the prior month with no new hires. Do not approve or release the payroll. Compare the register line by line against the prior period. For every employee with higher gross pay, confirm there is a manager-approved change authorization. The rate matches the HR system, and overtime hours are supported by an approved timesheet. If no legitimate explanation exists, escalate before releasing payment. Case E is a remote hire who has been working from a state the company has never been registered in, and no one noticed until the second pay period. The company has already run at least one payroll in an unregistered state, no withholding tax account, no SUTA account, and possibly no workers' comp coverage. The most urgent item is workers' comp. An uninsured claim creates direct, uncapped employer liability. Complete the new state expansion checklist immediately and register retroactively where the state allows it. Make the state nexus check a hard gate that blocks onboarding until confirmed. Case F is a CP 2100 notice from the IRS. TINs on 1099 NEC forms do not match IRS records. Backup withholding of 24% is now required. Send a B notice to each affected contractor within 15 business days, requesting a corrected W-9. If no response within 30 days, begin backup withholding. Implement IRS TIN matching verification for all new W-9s at onboarding and annually before 1099 filing. 14 red flags can signal compliance risk across both tracks, and many contractor red flags indicate misclassification exposure that is retroactive from day one. The single strongest misclassification indicator is a contractor with an indefinite engagement and no end date. Close behind, a contractor using a company email address or appearing on the org chart, or benefits offered or implied to a contractor. On the employee side, watch for new hire paperwork that is incomplete after the first payroll run, a new hire's work state that was never checked against registered states, and a headcount mismatch between the HR system and the payroll system. That is a direct signal of ghost employees or terminated employees still active. Any one of these warrants immediate action. Additional red flags focus on financial controls and documentation. An employee paid through accounts payable instead of payroll bypasses tax withholding entirely. This is an improper channel regardless of intent. Contractor engagements renewed automatically without retesting skip, the most important recurring control in the contractor process. No written services agreement or statement of work for an active contractor makes contractor status almost indefensible in an audit. No W-9 on file for a contractor paid $600 or more means backup withholding should have applied, and the 1099 NEC cannot be correctly filed, creating direct CP 2100 risk. Tax deposits made late or irregularly mean penalties are accumulating, and the trust fund recovery penalty can reach responsible officers personally. And 401k remittances made more than 7 business days after payroll represent a DOL prohibited transaction actively in progress. 15 process improvements emerge from the full cycle. 9 are high priority and should lead every advisory engagement where the client has both employees and contractors. First, implement a formal worker classification policy requiring documented analysis for every new engagement. Second, require W-9 collection from every contractor before any payment, with no exceptions. Third, make the state nexus check a hard gate in onboarding. No out-of-state hire proceeds to payroll setup until the state is confirmed registered. Fourth, implement and maintain a year-to-date contractor payment tracker updated after every AP payment, so the 1099 NEC total is always current. Fifth, run IRS TIN matching on all contractor TINs at least 60 days before January 31 to prevent CP 2100 notices before they happen. The remaining 4 high-priority recommendations are equally important. Keep employee payroll GL accounts and contractor expense accounts on distinct codes from day one. This enables misclassification detection, accurate ACA full-time equivalent counting, and clean audit trails. Implement dual review on all new employee setups before activating them in payroll to prevent ghost employees. Mandate period-over-period payroll variance analysis and headcount reconciliation before every payroll approval. And build a payroll tax deposit calendar with named owners and automated reminders. The 6 medium priority recommendations include automating 401k remittance, conducting annual contractor classification reviews, setting a maximum contractor engagement duration of 12 to 18 months, building a state-by-state final paycheck matrix, reconciling PTO liability monthly, and conducting an annual surprise payroll audit where management reviews the full register unannounced. The 2 tracks are deliberately separated in this training, but the highest value advisory work happens at the seam between them. The classification decision is where it starts. Every new engagement requires a documented analysis. The ongoing risk is that a contractor relationship drifts over time into something that looks like employment: indefinite duration, exclusive engagement, company equipment, benefits offered, or behavioral control exercised. A client that correctly classified a contractor at engagement start can still face misclassification liability 2 years later if the relationship evolved without anyone running the classification test again. Annual classification review is not optional. It is the recurring control that keeps the seam clean. Here are the key takeaways from Section 7. The employee and contractor tracks differ at every dimension, and those differences are exactly why classification matters. Advisory focus shifts by workforce profile, with heavy contractor use carrying the highest risk. Misclassification exposure is retroactive from day one, so correct it proactively. The 14 red flags that span both tracks, especially the contractor red flags, often signal the most severe and immediate exposure. And 9 high-priority process improvements, led by a formal classification policy, W-9 discipline, and the state nexus check gate, form the strongest foundation for ongoing compliance. This concludes the content sections. The recap brings the full series together.